Oh my God, the S&P, is that better? The S&P just jumped 10% from its Christmas Eve low. It's a very, very big bounce in a short period of time. Now what do? I'm here with Michael Batnick, as always, live from the compound. Stick around. We're going to discuss what we've just been through and what you can infer going forward. All right, Mike, so I think nobody would argue that by the middle or end of December, the stock market was as washed out short term as you've ever seen it. Like, that part was fairly obvious. I want to go through a couple of these charts here. The first one, and I'll let you explain what we're looking at, the percentage of stocks above their 50-day moving average got down to a very extreme low, meaning almost no stocks were above the 50-day moving average.
Yeah, it was pretty much near zero, which last happened in 2011 and 09 before that and 2002 before that. And you could look at...
Those are all major stock market lows, yeah. When we've seen zero stocks above their 50-day.
You could look at the 200-day or the 10-day or whatever. It was, whatever you're looking at, it was a washout.
Why do extremes matter? Why are they so notable?
Isn't that obvious? What do you mean?
Well, it's not. I don't think it's obvious.
What do you mean? Why do they matter?
So an extreme low in stocks above their 50-day moving average, meaning there are no stocks going up anymore. Mm-hmm. Why is that noteworthy to investors, to traders?
Well, because if all stocks are going down and the average investor is in something like an index fund, they're going to see it.
They're going to, right. So it weighs on sentiment is one of the most important things.
And price, obviously.
The other chart we're going to go through is the S&P 500. This is not a percentage. This is the actual number of 52-week lows in the index.
This is interesting. I didn't realize that there were more new 52-week lows in the S&P 500 in December than there have been since October 2008.
So obviously October 2008 has a fairly high significance in people's minds. And
so we saw previous spikes near bottoms. So January 2016, August 2015, and the fall of 2011. But like I said, you had one in October 2008, and that was not even close to the bottom.
You have 220 stocks had been making a new 52-week low in the third week of December. That's like a wild number. That's a big number.
It's a lot, yeah.
Now, that October 2008 previous spike, which it looks like it was an all-time record, at least in recent history, was not the bottom.
And how about this? So there was spikes in early 2008 that I didn't circle, but you could see a big spike. That was not even close to the bottom.
Yeah, you had one.
If you were like, oh, there was a spike in new 52-week lows, that's it, it's over.
Right.
You were pretty early.
So the October 2008 spike in 52-week lows happened 6 months before the S&P 500 bottomed,
and 10 months after the first spike.
Now a lot of technicians would say you knew March 2009 had to be close to a bottom because the number of 52-week lows is not repeating what we saw. So maybe that's a very useful gauge that not a lot of people look at.
A divergence of sorts.
Divergence. Let's look at, you want to talk about sentiment, because you had this washout in the percentage of stocks above their 50-day. You had a washout in terms of how many 52-week lows we were seeing in the S&P. You had a coinciding washout in sentiment.
Yeah, shocking how that works.
So do you want to go through what we're looking at here? This is the AAII sentiment survey. You have a chart here of the percentage of bulls minus the percentage of bears, expressed as a single number.
It's pretty wild that it went from extreme greed to extreme fear in the course of 12 months.
Okay, so you start off the year, you're somewhere early last year, you start off at 44% bulls.
So meaning that
bulls minus
the
bears.
Difference. So if bulls were at 65%, bears were at 21%. That's what this chart is showing in January. And then in December, the exact opposite happened. So washout in price, washout in sentiment.
Right. So here are the numbers. My friend Peter Bookvar basically saying that, first of all, let's look at the number of bears. You hit 29.4 this week, which is now the lowest since October 4th. But it hit a multi-year high in December. You had 50.3 bears, which is it's an extreme. Anything multi-year high, by definition, is probably extreme.
A few weeks ago, I called TD Ameritrade to figure out what was going on with their wait times. And I was on hold for 35 minutes before I hung up, and I didn't need anything. I was just like seeing what was going on with their phone lines.
You couldn't get through.
I couldn't get through.
What would you have done if you got through? Just said hi, or you actually were doing something?
No, I would have hung up. I was just seeing how long the wait time
Is that part of your research that I'm not aware of?
It was. I was listening to classical music in the background. It was actually quite pleasant.
Okay. Now the number of bulls bottomed at 20.9 in the middle of December. So that number is now 38 and change, which is not extreme. It's just somewhere in the middle.
All right, so you got the washout in price, the washout in sentiment, and then the subsequent bounce, which is not terribly surprising. Not saying I called the bounce right now.
All right, so you shared this chart with me. This is from our friends at Bespoke. Shout out to Paul, shout out to Justin. And this is
George,
a table.
Who probably made this.
George probably did the work. All right, so this is a table, big rallies off of a major low, 1945 to 2019. So the conclusion, what's the conclusion here?
Mixed. No, nothing is conclusive as usual. So they showed the forward 1 week, 1 month, 3 month returns, etc. And the question was there a lower low after the big bounce? 6 times there was lower lows, 6 times there was not.
So literally flip a coin whether or not we're going to see a lower low than Christmas Eve following this major bounce that we've just seen.
So again, I don't think that after the rubber band was stretched that far, I don't think the bounce was terribly surprising. Obviously, it was very hard to time. But
nothing is surprising in hindsight.
True. And the real question is now what?
Right. So if you're using history as a guide, it's not helpful.
All right. So now what? Tell me.
What do you do right this minute?
Yes.
So as we were saying before we shot this, I really think the answer, and it's frustrating, there isn't an answer that will appeal to everyone, but the answer always comes down to what kind of an investor you are. Are you a trader? Are you a long-term investor? Are you in the accumulation phase of life? Or are you actually living on your portfolio? And so all right, now what do I do? The market's now up 10% off the low. We're still how much off the high? 10%. We're in no man's land. Sentiment is back in no man's land. You've had a bounce in the percentage of stocks that are in uptrends. So are you now looking for the stocks that have gone down the least and saying, that's where the strength is, I'm buying? Or are you looking for the hardest hit stocks? Again, who are you as an investor? I don't think there's a more satisfying take than that.
I'm Paul Tudor Jones, personally.
So if you're Paul Tudor Jones, then you're probably fading the bounce and saying it's counter trend. We're still in a downtrend.
What if you're Harry Dent?
If you're Harry Dent, you're making as many television appearances as possible and possibly writing a new book.
So my take is this. So I have no advice for traders. That's worthy of advice for them. But for investors, like if you were really scared in December and you were like, all right, if this gets
now the pressure's off a little bit.
Right. So if you were very scared in December, but you didn't do anything, and now you're like, all right, coast is clear. Thank God, it's over. I would suggest that you seriously reevaluate how you will behave if we do retest those lows and it gets worse. And if we don't, great. But if we do and you sell, that is not good. So maybe now is a time to actually reassess what your risk tolerance is. And
now,
maybe if you were 70% stocks and you were freaking out but you didn't sell, maybe that's a little bit too much.
Right. Now, it's also important to remember that these types of drastic declines in bullishness followed by huge bounces when everyone's out, they don't necessarily signal the end of a trend. You would hope that we've seen enough pain to say this bear market's over, but until you make a new high, which we're very far away from still, no one's saying the coast is clear.
I would be way more surprised if we hit new highs and new lows. Would you agree?
I'm on record already saying a retest feels more likely to me. It doesn't have to be as fast, and you could have less stocks retesting, which would be great.
It could be 2 months from now.
Yeah, completely. We are still below, in a lot of sectors, we're still below the January 18 highs. Forget about, the September. Right.
Wait,
so
financials?
Financials. All right, listen, we want to know what you think, though. We've blazed through a couple of charts. What are we missing? What else should have been brought into this conversation? Go ahead and smash that like button if you're into the content that we're doing. Make sure you're a subscriber if you're not already getting our updates, and we will see you soon.